Okay, welcome back everybody. We are at week 14. We're getting close to the finish line here, and this is nearing the end of my lectures. But this lecture is important because we're going to talk about the numbers. So we're still on digital advertising. Last week we talked about keywords and content and introduced you to this concept of return on ad spend. And in this week's lecture, we're going to actually run a couple scenarios so you can get comfortable with understanding how easy it is to run these metrics. And metrics are, as described on this slide, with regards to return on ad spend, it's how much revenue a company receives for every dollar that they spend on advertising. So this is how we gauge how effective our campaigns are. Return on ad spend. And I mentioned in the prior lecture that a good metric for a return on ad spend is 3 to 1. So for every dollar of advertising that we spend, we're getting $3 back in actual sales. Now, when we talk about sales, we're talking about top line sales. That's just the number of units we sell times the price per unit. That's top line sales. It's not taking into account our actual profit. So we have the sales of our product, service, but we have expenses, cost of goods sold, etc., and we get to an actual profit number. So just because your sales are exceeding your advertising costs doesn't mean that you're making money. So we'll look at that towards the end of this lecture when we look at break-even cost per click, which really takes the profit factor into account. All right, you ready? Let's go ahead and get started. As you probably guessed, your learning objectives tie into this week's content. So by the end of this lecture, you should be able to calculate a return on ad spend. And you can do this for a variety of social media platforms. And then number two, you should be able to determine what is your break-even cost per click, which is really important when you're setting up ad budgets and getting ready to spend money in the digital space. You don't want to spend above what keeps you profitable for selling your stuff. All right, so let's run some numbers. Let's look at some metrics for the scenario that you see in front of you. So let's assume that you have an ad budget of $1,000 a day. Take out a piece of paper and jot that down. My ad budget is $1,000 a day. That's what I have to spend. That's a lot of money, right? That's $365,000 a year. Let's also assume that the cost per click, meaning the pay per click that you have to pay as an advertiser to reach your target audience, is $1.50 a click. And then let's assume that our opt-in rate is 25%, meaning 25% of the people that click on your ad actually give you their email, their contact information. They've opted in, they want to get more of your free stuff, and they've given you their email to do so. The fourth bullet point, conversion rate of 10%. That means out of the traffic that's coming in, 10% of those leads actually buy something, and the product that you're selling has a price of $100. Okay, so starting with the first metric on your last bullet point on this slide, I'm asking you, if you spend $1,000 a day, how many people visited your page? You know that your cost per click is $1.50 and that you have $1,000 to spend. So to determine how much traffic you received, you simply take your ad budget of $1,000 a day and divide it by your cost per click, $1.50 per click. And how many clicks will you get before you spend all of your $1,000? So $1,000 divided by $1.50, you would get 667 clicks, rounding up to 667. So jot that number down, and that is your traffic. So that's how many people actually clicked, and upon that, it took them to one of your landing pages on your website. You have traffic to your website through the clicks of 667. That's our first metric. All right, so we've spent $1,000 and we got 667 traffic to our website. So the second thing we want to know, and your last bullet point on this slide, the last bold bullet point, is how much of that traffic did you actually convert into leads? The difference between traffic is they just clicked. Leads is they've gone to the next step of giving you their email so that you can market to them directly. And when you have their email, that's a lead, and now you can market to them directly, and you're no longer reliant on that social media site. So we see that our cost per click was $1.50, and we see that our opt-in rate was 25%. That means out of all those clicks, which were 667, 25% of them opted in and became a lead. So my question here to you is, how much traffic did you convert into leads? You would take your leads and multiply it by 25%. 667 times 25%, you would get 167 leads. That's our second metric. Our third metric is to determine what was your cost per lead. So we know that we had 167 leads, and we know that we spent $1,000 each day. So this metric is very simple to calculate. What was your cost per lead? Take your total ad budget of $1,000 and divide it by the number of leads. And this metric can be done on a daily, a weekly, or a monthly basis. Most commonly, they often look at it on a monthly basis out of everything we spent over the month. If it was $1,000 a day, it'd be roughly $30,000 times the number of leads, 167 times 30 days. But in this case, we're just looking at one day. So we spent $1,000 a day and we got 167 leads. So our cost per lead is $5.98. That's $1,000 divided by 167. Now, why do we care about the cost per lead of $5.98? Because we want to compare that cost per lead versus other marketing and advertising efforts that we're using to generate leads for our business. So maybe there's another social media platform where the cost per lead is only $4. And maybe good old-fashioned direct mail gives me a cost per lead of $1, right? So when you know the cost per lead, you can evaluate your different media choices and determine which one is the most efficient, least expensive at generating leads for your business. Our cost per lead, $5.98. Jot that down on your piece of paper. Our next metric is to determine how many sales do you expect to achieve if you spend $1,000 a day. So let's look at the actual number of sales, meaning how many units we sold, and then we'll look secondly at the total dollar value of those sales. So we know that on the fourth bullet point up top, our conversion rate is 10%. So out of those 167 leads that we get, 10% of those leads actually convert, meaning purchase a product. We converted them. We made them into a sale. So how many sales would we get? Well, it's the number of leads, 167, times 10%. So that gives us obviously 16.7 leads. Let's go ahead and round it up to 17 just for easy math. So let's assume we got 17 leads for our $1,000. So if we got 17 leads and our product sales price is $100, we know that our total volume sales would be 17 times 100, $1,700. So we sold 17 widgets, and at $100 a piece, we made a total of $1,700. So we're making $1,700 a day. So now we know how many sales we got and what our total dollar value is of those sales. Let's go on to the next step. Okay, and now we get to our final metric, which is determining our return on ad spend. And you can see the second to last bullet point on this slide. The formula for return on ad spend is simply your total sales divided by your total ad budget. In this case, we're looking at it daily. So we know that we spent $1,000 a day. That's our ad budget. And we know that our sales, in this case, if we had 17 leads, we're rounding up from 16.7. If we had 17 leads at $100 17 sales, excuse me, at $100 per sale, that we generated a total of $1,700 in sales. So to determine our return on ad spend, we would simply take the $1,700 and divide it by the ad budget of $1,000. And our return on ad spend is 1.7. What that tells us is for every dollar of advertising that we spend, we get $1.70 in sales. So your return on ad spend should always be 1 or higher. If it's below 1, that means it's negative. That means you're spending more in your ad budget than you're getting back in sales. So in this case, our return on ad spend is 1.7. It's positive, and that's good news. But what we don't know is that good? Is a return on ad spend of 1.7 any good? So the great news about social media and all these metrics is you can go online and Google questions such as, what is the average conversion rate for blankety blank industry? What is the average opt-in rate for online businesses? These numbers in this scenario are quite rosy, quite high, meaning an opt-in rate of 25% is very high. And standard opt-in rates, you can Google search this on your own, you'll see that they're much lower, well below 10%. And a conversion rate of 10% is very high as well. So in this case, our return on ad spend was 1.7. Is that any good? Well, as I mentioned earlier in this lecture, a good kind of rule of thumb is a 3-to-1 ratio. So for every dollar of advertising you spend, you get $3 back in sales. So the bottom line question here is, did you make money? But making money has more to do than just the sales of your product, the purchase price that you're selling your product for. We want to know, the question we're trying to answer, if did you make money, is really, did you make a profit? And in order to determine the profit, you can't look just at the sale price of your product. You also have to take into account the actual operating costs or costs of goods sold associated with that product that you're selling. So say, for example, you're selling this product at $100. That's great, but it's not 100% profit. It never is. And in fact, you're lucky if you're getting 50% net margin on your product. So if we had a 50% margin, the actual money that we're putting in our own pocket on each sale at 50% margin is $50, 50% of the $100. So in this case, we would actually look at, did you make money? We wouldn't just look at the return on ad spend, but we would look at these numbers based on, did we cover our profit? Did we actually break even? So let's talk about that. So now we want to actually look at how much profit we're making with each sale. The purchase price, the sale price of our product is $100, but let's assume we're only making 50% of actual profit margin on that product, net margin. That means each product we sell, our margin is $50. And if we sold 17 of these, which was the 10% of the 25% opt-in rate, if we sold 17 and we're making $50 profit each, that gives us a total of $850 in profit, after sales profit. Did we make money? In this case, the answer would be no, because our ad budget, we spent $1,000 in advertising, but we got $850 back in profit. So for every dollar of advertising that we spent, we only got 0.85, 85 cents on every dollar that we spent in advertising. We're spending more in advertising than we're getting back in profit. So that puts us in the negative territory, which is not good. So I'm going to run a couple more scenarios, and then we're going to get into how we determine the break-even cost per click, so you make sure that you don't run into this scenario where you're spending more in advertising than you're getting back in after-sales profit. Okay, so let's look at another scenario. Here we have scenario 2. Now, we've increased our ad budget from $1,000 a day to $2,000 a day. So go ahead and take a moment, and I want you to walk through the steps and calculate What is your return on ad spend based on this new ad budget? The numbers you should calculate first off are how much traffic did you generate? How many leads did you generate? What was your cost per lead? How many sales in units did you generate? You could also look at your cost per sale. You could also determine your total sales volume based on the purchase price of $100, and then get to your actual return on ad spend. And return on ad spend is your sales divided by your advertising budget. So take a moment and crunch that. I'll wait for you here. Go ahead and pause my lecture for a second, and I'll come back in a second with the answers. Okay, so you've crunched your numbers. I'm back, and let's look at our actual numbers. So we spent $2,000 a day. We still have a cost per click of $1.50, an opt-in rate of 25%, a conversion rate sales of 10%, and a product sales price of $100. So based on a new ad budget, which is double at $2,000 a day now, we've doubled our traffic, and our traffic would be 1,333, which is simply the 2,000 divided by $1.50 per click. Gives us a total of 1,333 in traffic. That's our first metric. Our second metric is determining our number of leads. Our opt-in rate is 25%. So we would take 25% of our traffic, 25% of 1,333 would give us our number of leads, and that is 333 leads. That's our second metric. Now that we know our number of leads, we can also determine what's our cost per lead. We would simply take our ad budget, $2,000, and divide it by our total number of leads, 333. That gives us a cost per lead of $6. We then want to determine what is our actual total number of sales in units. We know our conversion rate is 10%. We know that we had 333 leads, and 10% of those leads actually purchased. That gives us 10% of 333, which is 33 sales. 33 actual sales in number. We know that our purchase price is $100. So to determine our total sales volume, it'd be 33 sales times $100 per sale gives us a total sales amount of $3,300. You with me so far? This is easy math. The next thing we want to figure out is our return on ad spend. So what was the number that you came up with? Hopefully you came up with a number of 1.65, $1.65, and that is simply taking the $3,300 in sales divided by your $2,000 in ad budget gives you a return on ad spend of 1.65. For every dollar in advertising that you spend, you get $1.65 back in sales. That's positive. So that part is good. But did we actually make money? So if we wanted to determine that piece, we would have to actually look at our profit. Let's go back and assume that we have a profit margin of 50%. So that product sales price of $100, we take 50% of that, and now we know that we're making $50 on each product that we sell. So now we would take our $3,300 in total sales and take half of that, 50%. That gives us $3,300 times 50% is $1,650. $1,650 divided by 2,000 in actual advertising expenses gives us a new net return on ad spend of 0.825. For every dollar in advertising that we spend, we're getting 0.825 cents back in profit. Okay. And that puts us in the negative zone. So that's our second scenario. Let's look at a third scenario. Go ahead and take a minute and run your numbers on this third scenario. What's changed? You can see that the cost per click has gone up from $1.50 to $2. So in the online world, your ad spend isn't static. You are submitting an ad bid, and you need to have a range of I'm willing to pay X and X. So with traditional advertising, you have a very specific ad price that you're going to pay. With online stuff, it can move around a little bit. You want to have a ceiling, don't go above this, right? And of course, you're willing to pay as low as you can get for your customer. But now we know that our cost per click has gone up from $1.50 to $2. How does that impact our numbers? Go ahead and take a minute now and run your new numbers based on this change. Ad budget of $2,000, cost per click now $2, opt-in rate is still 25%, conversion rate is still 10%, product price is still $100. Go ahead and pause the video now and run your numbers. How much traffic, how many leads, what's your cost per lead, what are your sales in units, and what are your total sales in dollar amount, and then what was your return on ad spend as a result of that. So go ahead and crunch those numbers now. You can pause my voice, and I'll come back in a second with the answers. Okay, so I'm back. Let's go ahead and crunch our numbers. You had an ad budget of $2,000. Your cost per click was $2. So 2,000 divided by 2, you're going to generate 1,000 in traffic. Your opt-in rate is 25%. 25% of that 1,000 is going to be your leads. 25% of 1,000 is 250 leads. Out of those 250 leads, 10% of them converted into sales. 10% of 250 is 25 sales. Backing up one step, your cost per lead would be the $2,000 in ad budget divided by your total leads of 250. That gives you a cost per lead of $8. Notice how your cost per lead has gone up. In the previous scenario, when it was $1.50 cost per click, your cost per lead was $6, and now because your cost per click has gone up to $2, your cost per lead has gone up to $8. So there's a correlation there. What are our total sales? We had 25 sales. That's 250 leads times 10%, conversion rate, 250, giving us 25 sales at a purchase price of $100. That's $2,500 in sales. What's our return on ad spend? $2,500 in total sales divided by our ad spend of $2,000. That gives us a 1.25 return on ad spend. For every dollar of advertising we spend, we get $1.25 back in sales. Oh, we're getting lower. It's almost a 1-to-1 ratio, right? And if we actually took this from a profit margin perspective and took those sales at 50%, well, now we'd be looking at total sales of $2,500. 50% of that is $1,250. $1,250 divided by 2,000, your total ad budget, gives us 0.625. For every dollar in ad spend, we're getting 0.625 back in profit. So we're spending more than we're actually getting back in money. We're in the negative, so no, we didn't make money. So these simple scenarios can be used to kind of test where you're at, and it's important that we understand these metrics. Many folks get caught up in setting up a budget and spending money and getting sales, and all of a sudden they realize, I'm in the negative, I'm losing money. And you kind of have to, if you can do this on the front end and kind of know what your parameters are of what you can spend, and return on ad spend is a very good metric, this will help you out. All right, let's run one more scenario. So this is scenario 4. You can see we've increased our ad budget. Our cost per click has stayed the same. Our opt-in rate is still 25%. However, our conversion rate has gone down to 5%. It was 10% before. That means the number of people that actually purchase has cut in half. We're not converting as many. How does that impact our numbers? What does that do to our return on ad spend? So go back once again and crunch your numbers. You want to first determine how much traffic you're going to generate on a $4,000 a day budget and a cost per click of $2. Then you want to determine what are your number of leads. Then you want to determine what is your cost per lead. Then you want to figure out how many unit sales did we produce at a 5% conversion rate. What did that transfer to as far as total dollar value of sales? And then number 6, what was your return on ad spend as a result of this change on the conversion rate? So this is a reality that as your business is going, keep in mind things aren't static. So your conversion rate is going to go up or down, and it doesn't take much of a change for things to go sideways. You're cruising along, you've got positive return on ad spend, you're making money, and then all of a sudden for some reason your conversion rate dips. People aren't converting at the same rate. Is there something wrong with your website? Maybe it goes down, you got a problem with the landing page, but for whatever reason your conversion rate goes down, but your ad budget is still spent at $4,000 a day and you're still spending that kind of money. So you have to be on top of this stuff. Take a minute, crunch your numbers, and let's come back in a second and you can tell me those metrics: traffic, leads, cost per lead, number of sales in units, number of sales in dollars, and return on ad spend. So pause the video now and go ahead and crunch your numbers and we'll reconvene in a second. I'm back. Let's look at our actual numbers. So we're spending $4,000 a day. That's a lot of money on a daily basis. $4,000 a day divided by $2 per click gives us 2,000 in traffic. 2,000 in traffic with a 25% opt-in rate gives us 500 leads. 500 leads divided $4,000 ad budget divided by 500 leads gives us a cost per lead of $8 per lead. Those 500 leads are now only converting at a 5% rate. So our sales are 500 leads times 5%, 0.05. That gives us 25 sales. And at a sales price of $100, those 25 sales transferred to $2,500 in gross sales. What's our return on ad spend? $2,500 in gross sales divided by our ad budget of $4,000. Uh-oh. This tells us we are negative. For every dollar in advertising that we're spending, we're only getting 0.625, 62.5 cents back in sales. We are way negative. So that subtle change in the conversion rate has thrown our numbers way off. What do we do at this point? Shut down the ads as quickly as possible, right? So did you make money? You can probably assume no, because out of those 2,500 in sales, let's assume 50% of that is still profit, meaning our actual profit is $1,250. $1,250 divided by our $4,000 in ad spend gives us a 0.3125. For every dollar in advertising we spend, we're only getting 0.3125 in profit. We're going negative quickly. So does this scare you away from the online advertising world? It certainly should give you to take pause. You set these things up and there's no guarantees, and you can have a lot of activity, a lot of followers, even a lot of sales, but at the end of the day, if you're not watching your metrics, you could end up actually losing money, and losing money quickly. So stay on top of our numbers. So how could we improve this situation in scenario 4? Well, there's a lot of things we can do to make our return on ad spend better and get us into a profitable zone. As you can probably guess, some simple things would be increase your price. If you can charge a higher price, well, that's going to give you better margins. So that certainly helps. You might sell less if your product is more expensive, however. You could also increase your margin. So we're talking about a 50% margin. What if you could get your margin up to 75%? If you've ever watched Shark Tank, it's one of the first things they ask. So what's your margin on your sales? How can we make the product more profitable, less expensive to produce, less expensive to sell? In the online world, I was mentioning in an earlier lecture, it's why there's so many information products out there. Information products, you're basically just selling you talking to your customers. There's no hard product that you have to sell that requires cost of goods sold and therefore automatically makes the margins much lower. Information products have a higher profit rate, profit margin, and therefore work better in an online environment. So you can increase your price, you can increase your margin, you could decrease your cost per click. Can you get your cost per click down and pay a lower rate? Maybe use some new keywords or some new strategies to get in at a lower cost per click. And of course, you could increase your conversion rate. If there's one thing that's going to move you towards profitability quicker, it's increasing that conversion rate, because the more you're already spending the ad dollars, the more of those people you spent advertising on that you can actually convert to sales. That is the quick ticket towards increasing your profitability. So conversion rate is a big factor. You saw in previous lectures, the two men from Google were talking about bounce rate. That means somebody clicked on your ad, they went to your site, they bounced out. They never even gave you their email, but you already paid for them as a click, right? So something's wrong with your website. They're not engaged with the material. There's something they don't like, that they don't go further and give you, opt in, their contact information. High bounce rates are bad news. So like I said, these numbers listed here for these scenarios are rosy, positive, very high opt-in rates, very high conversion rates. So you can go ahead and do your own Google search, or what are the average opt-in rates for online businesses, or pick a particular product category, financials or health and wellness or beauty, and what are the average conversions rates, and you'll see how low they are. So these are the challenges of online advertising and digital marketing. So take this to heart. The last piece I want to cover off on is how to determine your break-even cost per click, which at this point that should be of interest to you, because you realize we can go into negative territory quickly, and I need to know what is my shutoff valve, what is my maximum cost per click that I'm willing to pay, and I don't want to go beyond that because that puts me in the non-profitable zone. All right, we're getting to our last metric, cost per click. So this is a wonderful tool to make sure that you don't spend yourself into negative territory. So with this scenario on this slide, I want you to ignore some of the titles on the tables that you see here. So you see where it says CPA and CVR. Please disregard those. This is for London Fog, and they use kind of different acronyms than what we've been using. So disregard those. But this scenario, which is the one I could find that's not that's able to use Creative Commons license-wise, will work for explaining break-even cost per click. In the red text on this slide, you see the formula for break-even cost per click. You need your contribution margin and you need your conversion rate. Contribution margin times your conversion rate gives you your break-even cost per click. That sounds easy, but what is contribution margin, Nate? So let's go there. Assume you're London Fog, which is a apparel company in London, and you sell orange umbrellas, and you sell them at $35 each. Your cost to London Fog, your cost of goods sold to produce these umbrellas, is $10 per umbrella. $35 minus the $10 cost of goods sold gives you a gross margin, or what we call a contribution margin, of $25 per umbrella. That's your contribution margin. It's called contribution margin because it's the amount of your gross profit that you can apply towards your fixed costs. It's contributing towards your remaining costs, your other fixed costs. So we won't get too heavy into accounting, but cost of goods sold is the cost for each widget that you sell. There's the umbrella, and then the cost of goods sold would be the materials that go into the umbrella and the manufacturing costs for each umbrella, and maybe even the packaging for each umbrella, right? So that's the cost of goods sold. So we have a contribution margin of $25 each. So if you don't know that exactly for your product, you can Google search what's the average contribution margin or what's the average gross margin for XYZ product, and you'll find some numbers there. If you can't find those, you can always use kind of 50% as a ballpark number for your gross margin, and that is your contribution margin. Once you have your contribution margin, you just want to take that number and multiply it by your conversion rate. Your conversion rate, again, is how many you sell of your product. So in this case, we're bypassing, clicks give us X number of leads, clicks give us X number of traffic, and traffic gives us X number of leads, and leads give us X number of sales. We're going directly to the conversion rate, the percent of clicks that actually convert into sales. So in this case, we see for London Fog, for every 100 clicks they get 4 conversions, 4 sales. That's a 4% conversion rate. So $25 times 4%, 0.04, gives us a break-even cost per click of $1. What does that tell us? It tells us that if we're London Fog, we don't want to be spending above $1 on a cost per click basis, or we're going to go into the negative territory with our sales. So break-even cost per click is a wonderful tool. Again, you can take your sales price of your product, take 50% of that, and use that as a rough measure for your gross margin, which can also work as your contribution margin. And then you just need your conversion rate, and that'll give you your break-even cost per click. Why is this important? Well, you've seen from our prior scenarios that it's pretty easy to get into a negative spending zone, and you at least want to set up your ad parameters to not go beyond your break-even cost per click. Okay, one more way to look at all of these numbers and how they all link back and forth to each other. So first off, cost per sale. This is an easy number, an easy metric to calculate. If you go back to your ad budget, take your ad budget, 4,000, 2,000, 1,000, and divide it by your number of sales, that's your cost per sale, cost per conversion. We also looked at cost per lead, if you recall. Cost per sale kind of tells you how much it costs to get a sale on this person versus using a different media vehicle. And things to consider along these lines are, what is each conversion sale worth to you? Gross profit. And you can see the example here. Say, for example, you're selling cuckoo clocks, $100 each, and after all your cost of goods sold, you're making $40 in gross profit. That's your contribution margin. So in this case, each conversion is worth $40. Each time you make a sale, you're getting $40. Like I mentioned before, if you're not sure what the gross profit contribution margin is for your product or service, take 50% of your product price as an estimate. Another scenario, if you're selling subscriptions, you sell subscriptions, they're $10 a month, and there's after costs, and most people keep their subscription for 3 months. Each conversion, each sell of a subscription, which lasts for 3 months, is worth $30. Okay, that's good stuff to know. But going back to that conversion rate, remember we saw those conversion rates, and for our scenarios we used 10%, and for the London Fog example they used 4%. Another way to look at your conversion rate is simply to take the number of sales, not the dollar value, but the number of sales that you generate, and divide that by the number of cost per click that you have. Number of sales divided by number of traffic, amount of traffic, and that'll give you your conversion rate. So you can go back and test that on the scenarios and see that those come together. If you made 5 sales out of 100 clicks, 100 traffic, 100 traffic and 5 sales gives you a conversion rate of 5%. 2% is the average, so you can see how low these average conversion rates are. So hopefully this has explained the metrics to you in greater detail. You've learned how to estimate the amount of traffic, the amount of leads, the conversion rate, the amount of sales in units and in volume, and most importantly, your return on ad spend. And you've also understood now how to look at and calculate your break-even costs per click, because we know that in the online world, small changes in conversion rates, cost per clicks, can swing us out of our profitability zone very quickly. Okay, one final slide, kind of tying it all together. So here you could see with this scenario, you've got a profit of $10 per widget. That's your profit, that's not your sale price. A conversion rate of 2%, and 50 visitors equals 1 sale. You can see your profit, your conversion rate, your break-even cost per click of 0.2, et cetera, et cetera. So go ahead and digest this. I'm not going to quiz you on this specific example, but go ahead and digest this and see if it all makes sense for you. And now you know some of the metrics behind digital advertising. Wow, that was a lot of numbers. Thank you for listening through all that and crunching the numbers along with me. I hope you appreciated that discussion on metrics. Here's your homework for this week. Thanks for listening. Email me if you have any questions. Bye-bye.